Hello all, welcome to Just de Novo. If you've been quite conscious about monthly interest income from your saving accounts, the recent downwards revision of interest rates by major banks might be a concern for you. For example, both Standard Chartered and OCBC have made the revision in interest rate with effect from 1st July 2020, while CIMB will be in effect from 15th July 2020. Whether you already have a strategy in mind, in this video, we will be covering quite a few bank accounts: DBS Multiplier, OCBC 360, UOB One, Standard Chartered JumpStart, and CIMB FastSaver in terms of how you can really maximize the risk-free return offered by these banks that you can get for yourself. Of course, these rates are going to change, especially after our review. We noted that there's one clear winner among these bank accounts. Assuming there's no further revision in interest rate, our saving account strategy from July 2020 onwards will be as of below. If you are a fresh graduate and aged below 26, no doubt Standard Chartered JumpStart should have been one of your top choices in the past, whereby you get 2% per annum for the first 20,000 Singapore dollars in your savings accounts. There's no lock-in period, no minimum spending, no requirement for salary crediting, and no minimum deposits. It comes with a cashback debit card for about 1% with no monthly or annual fees. However, with effect from 1st July 2020, the revision interest rate may bother you. The 2% per annum interest rate for the first 20,000 Singapore dollars is now slashed to 1% per annum. So if you've done your calculations, total interest income per year will be 200 Singapore dollars, which is really pathetic. You can easily earn this from other options. However, if you're aged 26 years old and above, believe you've heard about CIMB FastSaver account, whereby you can park your extra cash after main salary credit accounts, which we're going to share with you shortly. This CIMB FastSaver account easily earns you 1% per annum for the first 50,000 Singapore dollars in your savings account effortlessly. However, the sad news is, a few days ago, CIMB has announced the revision interest rate, and effectively you only receive 0.5% per annum on the first 50,000 Singapore dollars in your savings accounts from 15th July 2020 onwards, which is actually better than nothing if you're not sure about what to do with your excess cash on hand. And now, the first fantastic salary credit account would be nonetheless the DBS Multiplier account. If you already have a mortgage with DBS, this is a must-have account with DBS, as this multiplier account is the best account that could optimize your savings following the revision. The DBS multiplier account works pretty simply: salary crediting and a transaction in one or more of these categories, which include mortgage, credit card spending, investments, and insurance. To maximize, simply credit your salary and transact in 2 to 3 categories as above mentioned. In our view, the easiest category to achieve would be credit card spending and investments, as DBS does not impose a minimum credit card spending requirement. It can just be a $1 transaction on a bus or MRT ride. On the other category, investments, it is also achievable in the sense that you just have to set a regular savings plan for unit trust or ETFs with a minimum of 100 Singapore dollars per month. Here you can easily target 2 categories. If you do have a home loan installment with DBS, congratulations, you get the best deal from this account. We personally do not consider insurance category because it's just not simply worth signing up for if your goal is to yield greater interest income on your savings. Now, let's do some calculations for DBS Multiplier. Assuming you're a salaried person of 5,000 Singapore dollars take-home pay per month and manage to have 2 transactions in a month, you would have earned 2.2% interest income on the first 50,000 in your bank account. If you do not manage to have 2 transactions, but only 1, which is a no minimum credit card spending, you are still entitled for 1.8% on the first 25,000 in your account. Sounds good, right? The next product, UOB One account. This account practices the tier-based interest rate, whereby the higher amount you save, the higher interest income you will obtain. Different from the DBS multiplier, UOB One is targeting someone who spends 500 Singapore dollars consistently on a monthly basis, and the requirement for salary crediting can be easily replaced by 3 gyro debit transactions. The account comes hand in hand with the UOB One credit or debit card, which provides further cash rebate upon fulfilling the minimum spending requirement. However, if you are not a big spender, having this UOB One account will be like a burden to you in terms of what to spend. Should you fail to meet the spending requirement, your interest income will be calculated at the current base interest, which is only 0.05% per annum. If you've done your calculation, you need to have 75,000 Singapore dollars in the UOB One account and constantly spending at least 500 Singapore dollars per month in order to have the maximum effective interest income rate on your UOB One account of about 1.8% per annum only. Over here, if you still recall the DBS Multiplier example earlier, an average salaried person with 5,000 Singapore dollars take-home pay with one transaction only, say credit card spending, he will be able to receive 1.8% per annum on his first 25,000 Singapore dollars in the savings account. As compared to DBS Multiplier, UOB does not seem very attractive to us. Last but not least, the OCBC 360 account. With the revision in interest rate by OCBC with effect from 1st July 2020, the requirement is getting simpler. By simply crediting your salary of at least 1,800 Singapore dollars by gyro, you will be entitled to 0.6% per annum and 1.2% interest income on the first 35,000 Singapore dollars and the next 35,000 Singapore dollars respectively in your savings account. This will effectively mean you get 0.9% per annum on your 70,000 Singapore dollars savings by crediting your salary with them and doing nothing else. However, OCBC does reward you with 0.2% to 0.4% per annum on your $70,000 savings account if you increase your account balance by 500 Singapore dollars every month. There's no spending reward attached to this OCBC 360 account, so you may think about whether it's still good to keep using the OCBC credit card. Similar to DBS, OCBC does offer investments and insurance categories. However, but to be qualified for these categories, you will have to spend quite a huge sum of qualifying amount, which we are of the view that it may not be that worth it. Regardless of whether you're a fresh graduate or your age group, so long as you're receiving a fixed monthly salary, I guess the choice would now be DBS Multiplier or the OCBC 360, since it only is beneficial in crediting your salary to either of these accounts. Considering the achievability of the requirements for higher interest rate, DBS Multiplier would be an absolute winner. While you may easily hit 1 to 2 transaction categories for DBS Multiplier, the drawback is the relatively high effective interest income rate is only applicable for the first 25,000 Singapore dollars if you have only one transaction and 50,000 Singapore dollars if you have 2 transactions. In our view, if you're spending at least 500 Singapore dollars per month, it also makes sense to maintain a UOB One account so you can put your excess cash into this account to generate a higher yield. However, you may consider the CIMB FastSavers or the Standard Chartered JumpStart if you're 26 and below. Alternatively, you may also explore some of the investment opportunities in equity, ETFs, bonds, mutual trusts, etc. Do share with us your view and let us know if we have missed out on any other interesting salary credit accounts in Singapore. Thank you!